money works better if it's allowed to compound. That means if money pays you interest, allow that interest also to become principal through the power of compounding, and it grows faster. I encourage every Kenyan to get a financial advisor. And you can get them. We have a lot of them in all mutual, and there are a lot available in the country. And the beauty about advice, you don't have to take everything. It just informs you, it increases your curiosity, increases your knowledge, and then you can ask. If the advice you are being given is not understood by you, or is too technical, or the advisor is using their jargon because they are knowledgeable than you, then that advice is not good for you.
If I had 1 million shillings on this hand, and on my other hand, 1 cent that will double every single day for the next 31 days, which one will you choose? Good morning, Power Tribe, and welcome to this episode of the Power Dialogue Africa, where we will be unlocking the secrets behind wealth creation and financial empowerment as we continue on our norm of empowering you one conversation at a time. Today, we are honored to host a visionary who's at the forefront of East Africa's investment landscape. Our guest is not only a seasoned leader, but a trailblazer who has shaped the region's asset management industry across multiple institutions. Our guest today is the Group Managing Director at All Mutual Investment Group East Africa. Anthony Mwithiga's journey is nothing short of remarkable. From founding CEO roles to steering strategic investment teams at some of Kenya's top financial institutions, he's built a reputation for transforming ideas into impact and for championing the integration of environmental, social, and governance principles long before they even became buzzwords. With an MBA in finance, a background in mathematics and economics, and credentials from leading global institutions, Anthony brings both depth and breadth to this conversation on how money really works and how ordinary Kenyans can harness its power to build generational wealth. At the Power Dialogue Africa, we believe in celebrating legacies that inspire progress, and there's no better partner for this vision than Sarova Panafric. Born from the bold ambitions of Stelios Stylianides and inaugurated by Kenya's founding father, Mzee Jomo Kenyatta, Sarova Panafric is more than a hotel. It's a symbol of Pan-African unity, cultural celebration, and visionary leadership. Just as the Power Dialogue Africa brings together trailblazers from across the continent to share ideas and ignite change, Sarova Panafric has for over 6 decades hosted presidents, pioneers, and patriots who shaped Africa's future. Today, it stands as a beacon of neo-African elegance, blending rich tradition with modern comfort, all while championing sustainability and community empowerment. We are proud to partner with Sarova Panafric, a space where history meets innovation and where Africa's stories continue to be written. Here's to creating powerful dialogues in a venue that embodies the very spirit of our continent's rise. Today, we'll explore the habits that separate the wealthy from those who are struggling, demystifying the world of investment funds, and uncover the practical steps anyone, regardless of income, can take to achieve financial freedom. Yeah, good to have you here, one of my most sought after guests. And from suggestions from our audiences, you really must be very accomplished on what you do. Congratulations for that.
Thank you. I hope so.
If someone is to come across this interview for the first time,
Yes.
what 3 things would you like them to know about you that define you best as a person and as a professional that you are?
Wow. Yeah, that's interesting. I just want them to know me as a Kenyan, a very optimistic person. Secondly, and thirdly, as somebody who believes in the abilities of all of us, regardless of our financial or training or academic background.
So we all can make it and be wealthy. That's what you're saying. Amen to that. I'd like for you to tell us a bit about All Mutual Investment Group. What does All Mutual Investment Group do, and why should we be interested?
Yes, thank you for that, Zeddy. So Mutual Investment Group is the brand name we use for our asset management business across the continent. The All Mutual Group has been around the world for more than 180 years and has been around in Kenya for more than 100 years. All Mutual, as a business, is mainly in four areas. We are in investment management or investments or asset management, and that's where I lead the team in Kenya and East Africa. And then secondly, we are known to be insurers. I'm sure you know Old Mutual has been the insurance business for a long time. Yes. So we are also secondly, in general insurance. For example, we provide motor insurance to your premises, machinery, etc. Thirdly, we are in life insurance, or life insurance, as we call it. So we insure lives and associated benefits for long-term purposes. And then lastly, and people don't know this, Old Mutual is in banking. In Kenya, we are in banking through Ford Microfinance Bank. It's owned by actually Old Mutual. And across the continent, we're in banking in various entities, directly and indirectly. And lately, Old Mutual, the group, has set up a digital bank, which is currently in formation and licensed recently from South Africa. In the continent, we operate in a number of countries. We have a presence in East Africa in 4 countries. We have a presence in West Africa in 2 countries. We have a presence in Southern Africa in 4 countries. And then, of course, we consider South Africa specifically, Cape Town and Johannesburg as the group's head office at the moment. Previously, the group had a presence in Europe, specifically in the UK and China. But for All Mutual Investment Group, as a business, the one I'm responsible for, we do 3 things. One, we help institutions invest long-term and short-term. So short-term is for companies who want us to help them manage their liquidity by offering a treasury management functions. Again, institutions in the form of pension funds, which we offer pension fund management services to their employee benefits for their future once they retire or they come out of active employment or working life. And thirdly, the general public, the mass market, where we provide retail investment products, commonly known as in Kenya, unit trust. And the most famous unit trust is called a money market fund. And I'm happy to know that currently its acronym MMF is a buzzword. Yes, it is. I couldn't wait for that. Yeah.
Thank you so much for that, Anthony. From investment to insurance to banking, I want to have asked a better person to tell us how money works. How does money really work? And we have seen that Kenyans have peculiar habits. I'd want to piggyback on your knowledge. What are these patterns that Kenyans are known for? And in layman's term, how does money work? Process patterns, how does it really work?
Yeah, I mean, Kenyans in terms of money are known as to be highly entrepreneurial because the high entrepreneurial characteristic of the average Kenyan is in pursuit to earn money, to create something financially for themselves. And money works from what we see it can do. It builds enterprises, it builds families, it builds individuals. The most important thing, how money works, it pays bills. But there's one thing unique about money which I would want our listeners and our viewers to start paying more attention to. Money works better if it's allowed to compound. That means if money pays you interest, allow that interest also to become principal through the power of compounding, and it grows faster. The last item about how money works is the ability for it to give us some form of freedom, financial freedom. I like call it more financial wellness, because we have physical wellness and also we have financial wellness. The day Zeddy, you and me achieve financial freedom, we've achieved a big part of our life ambitions and pillars. And if you look at it, there are around 6 stages which quickly give us financial freedom. One is we have to be trained or go through schooling to acquire a skill. Secondly, we have to be economically engaged, either by being an employee or an entrepreneur or starting a business. Thirdly, we need to start saving. And fourthly, we need to start investing. The difference between the two, I know the two words are used interchangeably. Saving is when we are a bit risk averse. Investing, then we want to take higher risk for higher return. And then number 5 is we need to be conscious now. We've starting to make money through investing. Then we need to seek for ways of protecting what we've earned, what we've built through various forms of protection, insurance, etc. If you're an entrepreneur, the best asset you have is yourself as an individual. Look for life insurance policy. If you've bought an asset, make sure it is secured. So protection is the 5th important stage for creating. And then the last stage is, I'm told no one is going to leave this world with anything. So let's use our financial journey and freedom to create a legacy which lives beyond us. And the term legacy is not used to mean being very rich or very wealthy. No. It's just what you did with money over those 5 stages. What do you want us to remember you for your interaction with money? Whether your legacy will be how you've used your little income or earnings to change the society you live in, to empower your family, to make Kenya a better place for all of us, etc. So that when we talk about money, we don't say Zeddy had a lot of money. We say Zeddy used her financial resources to empower her village, to empower her family, her peers, our country. Thank you.
And I believe that's in the Bible. A wise man leaves inheritance for his children's children. Very important. There's an element that you have mentioned, compounding effect. Could you just tell us simply what is that? Because there's a story I came about in that a difference. It was one of those leading economists and known figures and how they made their money. Just a difference of waiting for money to compound a few years more makes a world of difference. How does compounding work, and is letting money sit in the bank wrong? Because sometimes as Kenyans, we don't want to spend money. We believe if you have money in our banks, we are wealthy, we are liquid. Yeah. What is there a problem in having money sit in the bank? And how does compounding really work?
It's a very good question, and I really wish our listeners can really get it the way you've asked it. How does compounding work? So the compounding is the natural tool which makes money grow faster. So without compounding, money through an asset grows through value appreciation. You know, the way a piece of land was 100,000 next week or next year, it's 200,000. That's appreciation in value. The way a building appreciates in value. The way some sorts of investments like bonds appreciate in value. So the other way money appreciates or grows quickly is through the power of compounding. And compounding is actually compound interest. There are 2 types of interest computation. There's simple interest and compound interest. And I don't want to invoke my economics or mathematics knowledge here so that I don't lose our viewers and listeners. Compounding interest, what it just means is that when you invest an amount of money, you earn interest. Either end of the month or end of the year. Assuming it's end of the month. End of the month, you have 2 figures. You have your principal amount, assuming it was 100,000. Then you have an interest amount. The interest is computed using the interest rate you're earning and the principal. If you are earning interest of 10% on 100,000 per year, that is 10,000 shillings. Now, that 10,000 shilling, if it is not taken for consumption, but retained the investment, it becomes compounded interest. Because now your new principal is not 100,000, is 110,000. Now, when you start your next cycle of investing, your principal is 110. If you earn 10% again, your principal will be bigger again. Now, that compounding nature has been shown over a period of time. It shortens the period on which money grows than any other way of investing. It's actually believed to be one of the miracles of growing money.
Is that the time value of money, or what does the time value of money mean in finance?
It's slightly related, but just time value of money means that money grows with time and loses value with time if it is left idle. Exactly. Whichever, even under the mattress, under the bank, in your M-Pesa account, anywhere. But there are ways now through M-Pesa, through the bank, through investment managers like where I work, where money can never be allowed to stay idle. In fact, the only way it stays idle today, if it's in your pocket or under the mattress, which is the historical way of storing money. So time value of money, it just tries to show that you have more value in your money if as day or time passes, it's earning something and is not staying idle. One of the reasons why we keep money in the bank, and the main reason, is actually safety. And safety comes with a cost. And that's why that cost is for you not to earn anything. Because someone is protecting it. Exactly, literally. And you don't have to worry about it. But today, banks and other institutions have realized that there is more to them than providing us safety for our money. They are also now showing us how to invest. All those exactly. And hence, institutions like ourselves at Old Mutual, we are also helping people not to just leave their money idle, not to only be comfortable with safety, but also a return. Because you can achieve both. You can achieve safety and just growth of your money at the same time.
And now that banks are diversifying, yes, I believe even in our knowledge, you're trying to diversify. And I'd like to know, when does knowledge that you have become a burden? Because as Kenyans, we have fear of missing out. We want to do everything for ourselves. If I hear about MMF today, I'll go look up what it does and what have you. When does one get to need a fund manager? Because if I'll read up on MMFs or unit trusts, I'd want to figure out how it works. But what's the difference between me doing this for myself and me using a fund manager or an investment manager? What is the return on that investment? And do you encourage people to do it on their own, or do you believe there's more value and saving of time if someone uses a fund manager or an investment manager?
Thank you for that. And that's an important question, because the question leads to, when do you need advice and when don't you need advice? It's just like in managing your health. There's a time you feel you need to treat yourself or self-medicate, which is highly discouraged, and there's a time you need to see a doctor. The same thing about money. There's a time you feel, I know what I'm doing, but there's a time you feel, I need an advisor. In financial services, I want to say this. It might be one of the few areas where getting advice actually does not cost you anything.
Really?
Exactly.
You're not charged?
Exactly. And I'm impressed by your surprise. Because that is the truth. Financial advisors in this country provide advice in all areas of finance. In investing, in banking, in insurance, and any other form of financial service you're looking for. The only thing as Kenyans, we've not managed to embrace them, invite them, and listen to them. because as an individual, you don't pay them. They're paid by the promoters of the advice they promote. So today, I want to say this. I encourage every Kenyan to get a financial advisor. And you can get them. We have a lot of them in All Mutual, and there are a lot available in the country. And the beauty about advice, you don't have to take everything. It just informs you, it increases your curiosity, increases your knowledge, and then you can ask. If the advice you are being given is not understood by you, or is too technical, or the advisor is using their jargon because they are knowledgeable than you, then that advice is not good for you. The advice should be good for you if it's understood by you. Now, coming closely to what you have asked, when do I know I need a fund manager? One of the ways to know you need a fund manager is when you need to invest in a regulated product, and I will come to that. Financial services is regulated by a number of regulators. Of course, you know banks are regulated by the Central Bank of Kenya. Fund managers where I work at Old Mutual, we are regulated by both the Capital Markets Authority, CMA, and the Retirement Benefits Authority, RBA. Saccos are regulated by SASFA. Insurance companies are regulated by the Insurance Regulatory Authority, or IRA. So anytime you've shown interest in a financial product, saving, investing, protection, or otherwise, ask which financial regulator regulates this product. Once you're given the answer, you'll realize that product is being offered. If it's an investment product, it's being offered by a fund manager. Because a fund manager cannot distribute and sell an investment or saving product if they are not regulated and licensed by the applicable regulators. Now, why it is a bit hard to avoid a fund manager, even if you've not knocked to their doors physically and said, I need help, is because there's a high chance the product you are consuming at the moment, for example, unit trust. And the most famous unit trust is called a money market fund, abbreviated MMF. All MMFs are offered by fund managers, and all fund managers are regulated and licensed by the Capital Markets Authority. So when you're buying an MMF, you're actually indirectly using services of a fund manager without knowing. The only difference is that MMF has been offered you by a salesperson who we call a financial advisor. Now, sometimes you might say, now I actually need to see this fund manager who have subscribed to their MMF. It's very easy. There are two ways. If you're invested in an MMF, you get a monthly statement. Look at it and reach out to the fund manager institution in any way, using their social channels, telephone, or walk in if you are traditional like myself. The other way, and I'm encouraging investors in unit trust and MMFs, for example. Do you know unit trusts have annual general meetings, just like Saccos? You need to actually attend and listen and ask questions. And nowadays it's very virtual. You can listen it from when you're traveling, you are back at home, you're in the office. And currently this season is actually the season of unit trust AGMs. And sometimes I'll tell you as a practitioner, we struggle to get the minimum quorum for our investors and our clients to attend these meetings. So that's why you're in touch. Now, lastly, if you are an institution, either looking for a fund manager to manage your pension fund or a fund manager to manage your corporate cash. For example, where we are seated, this institution might have money which it does not want to use to expand the business, but want to invest short term. It also needs a fund manager beyond its bankers. Now, there are 5 things you need to look when you're looking for a fund manager, or you want to know you have the right fund manager for your product, like a unit trust, or to get an institutional solution like a pension fund management or treasury management of your liquidity. One, as I said, they have to be properly licensed by the appropriate regulator. And you can tell that. You can go to the CMA website and see XYZ fund manager or the mutual investment group is licensed by CMA. Tick. Number two, there is a benefit with time. We can't take it away from. That's why we might not like it a lot, but we have to listen to older people. Sometimes they claim, and I think they have seen more than us. So there's a bit of wisdom in that. Look at how long that business has been in existence of fund manager since its licensing. Number three, look at the products they offer and services and see whether some of those products are actually not attractive to you, but practical for you. Number four, try to understand a bit of how that institution is organized and managed and run. How is the leadership? How are the people who work there? This information is very transparent. It's all available. If you want to know what Anthony is all about, it's a click of the button. So, and all that is available. So understand the people behind the institution, both from management and ownership. It's important. And number five, now it's where the rubber meets the road. The products they are offering, what has been their investment performance, where our listeners call it, or our clients call it returns. How are those returns been in the past, in the recent past? As much as in investment we say past performance is not necessarily an indication of future performance, but that will tell you a bit of an idea. How do they, and if they have low returns, why? If they have high returns, why? You need to worry about the both. Don't clap for the high returns or get easily attracted. Ask, how are these returns being delivered? Why are they so high? And why someone is having low? etc. Those basic 5 things can make you choose a fund manager. I'll be honest to say, most of us, or most of investing public, choose fund managers for 3 reasons. 1, from the product. So you buy the product before knowing who is the fund manager, because the product is so attractive. It's like joining M-Pesa without knowing it's from Safaricom. Then you say, no, I'm not in Safaricom, I'm in M-Pesa. Then we tell you, no. Safaricom is by M-Pesa. So it happens a lot in investments. A lot of people choose a fund manager without knowing, by just subscribing to one of its products. The second one is by referrals by anybody, friends, relatives, colleagues. Financial education or literacy is one of the easiest way to become an expert. Sometimes some of us who spend all our life here, we think we have new experts who are speaking on our behalf, and we encourage them. We also kindly request them to remain factual. Yes. The third one now is if you get in touch or have contact with a financial advisor. I really want to encourage financial advisors out there. Speak more. Say who you are. Say how can you reach me? And let people know that they can get service from you without you paying them. Because financial advisors don't ask money from the public. They actually advise you and show you the bouquet of solutions, investments, or products they are selling on behalf of the institutions they represent. So those are the 3 likely you are likely to get into a solution or an investment product.
That's really good. I really didn't know fund managers can be accessed for free by virtue of you using their products. That I will take away from today and go look out for them.
And just to qualify there, it's not that they don't charge a fee. When you buy the product carries what we call a management fee. But they will not charge you for consulting them.
They'll charge you for managing
your money, yeah. But for seeking advice, yes, to be listened to, just like the way we consult doctors and we have to pay a fee, this is slightly the opposite. Your general inquiry and consulting on what you should invest in is not necessarily chargeable. But once you subscribe to the product comes with a management fee, which, again, for the benefit of the public, does not really impair the return expectation. Because again, those charges are also monitored and regulated by CMA.
Speaking of charges, Anthony, there's been this discussion I've seen going on some forum about the management fees that is charged on most MMFs from 2% downwards. How does a fund manager decide on how to charge? And does that impact the return on investment of the clients who are putting in their money? Because some are capped, all of them are capped at 2%, but some charge as high as 2%, and some are way below that. Is that a competitive edge for some of the fund managers, or when is it charged at max and when is it lessened?
That's a very good question. So the general advice for me is this: don't choose a fund manager or a financial product or investments based on the fees they charge. They're charging low and if they're charging high. The main driver should be you understand the product and you like the return. And then understanding the product means you understand its features and any likely risk in the product. There is no investment product which does not have an element of risk, just because that risk is so managed by the experts until it does not materialize. Because there are two cousins in money. One is called return, another one is called risk. That's why we say those returns in our language are risk adjusted. Now, you're very right that for example, in the unit trust industry or MMFs, people know more of MMF. And I repeat, MMF is a form of a unit trust. Other unit trust funds are equity fund, balance fund, fixed income fund, special funds, and we can discuss about that. So the fees actually range for what we call normal unit trust, the traditional unit trust. The fees can range between 1% and sometimes 3% for different reasons. But 2% is almost an average. So it's a very common fee, the 2%. But it doesn't mean it's the minimum or it's the maximum. And remember, fund managers are allowed by the regulator to prescribe the fee and justify why. Because the regulator is not here to regulate pricing. They monitor pricing, but they don't necessarily regulate. They expect, because we're in a free economy, product of goods and services need to find their own balance. If you overprice people, you'll miss customers. If you underprice people, you'll have a badly managed or produced product. Now, what you need to know, when you see a product has XYZ%, let's say a money market fund has 12%, what you need to inquire from the promoter of that money market fund, are these returns growth of fees or net of fees? It is highly recommended and required by the regulator. Those returns are reported as net of fees. So when you see that 12%, that is your return. No one is taking more money from you that, other than maybe any applicable taxes. Now, when it is net of fees, it means the management fee of 2% has been removed or has already been charged. Use that word, has already been charged. So the 12% is actually net. Now, sometimes if it is gross, it is not being netted. That means when you get the detail in your statement, the return might be lower. Transparency of returns is one of the biggest things as fund managers we encourage players to do. And I carry an industry responsibility. Actually, I'm the chairman of the Fund Managers Association in Kenya. So I encourage all my fellow fund managers just to be very transparent in pricing or in fee declarations. And let's follow what we all need to do, which is net of fees. And there's a document you get which shows you the fee. The fees are very transparent. They're not hidden. But sometimes the fee varies because of the complexity of the product. So there's a product called an equity fund. An equity fund is actually a unit trust, just like a money market fund. The difference is the equity fund invests in shares, for example, at the Nairobi Securities Exchange. The skill and work and effort required to manage an equity fund is slightly higher than a money market fund. So you find an equity fund might have a higher fee, or the fund manager may charge a higher fee, maybe 2%, 2.25, or 2.5, or sometimes even 3%. And they'll justify and they'll tell you why. Lastly, there's a new group of funds licensed and regulated by the Capital Markets Authority called special funds. I'm sure you've heard about that. So special funds are just another class of collective investment schemes. So collective investment schemes is the umbrella terminology for unit trusts. That's where they belong. Now, there's a class there called special funds. Their biggest difference with normal unit trusts, they carry a slightly higher level of risk because the fund manager is allowed to do more and be more, let me not use the word experiential, but be more creative in generating returns beyond many borders, beyond many investable instruments. And there's a higher level of skill required to do that. And those special funds come with a slightly higher risk. They come with slightly higher requirements on accessing your money. That means it's not like unit trust where there's a day to 3 days. Can be maybe 3 months, 6 months, 1 year, depending on the promoter of the fund. Secondly, they require higher minimum investment amounts. In Kenyan unit trust, even with 1,000 shillings, you can invest in a money market fund. In special funds, you might be required to put on the table or to invest 100,000 shillings, 250,000 shillings, 500,000 shillings, 1,000,000 shillings. So those are some of the differences of the special funds. And with those sacrifices of getting your money less often, being asked to write a bigger check at the start, taking a higher level of risk, then they come with a higher return. But also, they also come with a higher charge. Special funds might charge between 3 up to 5% because the fund manager of a special fund puts more resources and skill set in managing that product. Globally, for the benefit of our more knowledgeable listeners, special funds can be called hedge funds. Yeah. They can Google that. And that tells you why they charge more, why they have higher returns, why they have a lot of restrictions, and why they can be less liquid, etc. Yeah.
Thank you for that, Anthony. And from the latest statistics from KNBS, more than 75% of Kenyans earn less than 100,000 shillings a month. How do we get to wealth creation with what we have so that we can get to experience all these products and get to generate wealth?
Yeah, I think the earning ability of poverty is a huge drawback in wealth creation advancement, and that's why if you're from the village like me, you had to go to school and get a job and finally come to Nairobi. Thank God I'm here. But that's not the route only today. You don't have to go to school to get a job. I'm among the last few people who should have that mindset. You should get skills to earn a living, whether through your own skill, or if you want to take the traditional way, get a job or be employed. But there's a huge movement for self-employment, especially for the young people, and I'm very proud of that. I spend a lot of time with young people who want to build their own enterprises or be self-employed, because that's what I was not able to do. One thing we like about unit trust, they're playing a small part in building wealth from very low investable amounts by recognizing that we are still a developing country. We are still slightly higher levels of poverty. Our earning potential is low. That's why 1,000 shillings is available to invest in a money market fund. And the collective nature of money market funds through the umbrella unit trust structure helps us do that. There's a very close relationship between the philosophy of unit trust and the philosophy of Saccos. It's come together, small amounts, many of us, to build a big thing. The only challenge comes with one thing. When you have small amounts, many people, management becomes critical. That's why sometimes you get negative stories of mismanagement, especially in Saccos. Thank God we've not had mismanagement news or stories about unit trusts, because they are highly regulated, they are managed and offered by very competent, qualified fund managers, and there is technology to help us invest without either paperwork and without having to move around. Because if I have 1,000 shillings and I'm coming from Nakuru to Nairobi to invest in a fund manager in Nairobi, that's not economically viable, because half of the money or 3/4 of the money would go by bus fare. Today, sitting all over Kenya, you can invest in a unit trust with 1,000 shillings, depending on the technology you use. I must say, unit trusts have really, really played a big part in raising the savings culture in this country, because the money market fund is just a one step above your bank account. Well, especially if you're in a bank account which does not earn you interest. So the money market fund is as liquid almost as money sitting in your current account, but earning you interest without necessarily a higher level of risk, and giving you the security, the safety you've been looking for in a bank account, but still earning you a return. Now that interface is a huge breakthrough in building savings, because the money collected by unit trust in this country now is close to 500 billion in this country, can be used to do other bigger things and still generate returns for the unit trust or the money market fund investors. That's the little way savings in a country where earning potential is very low is helping. I mean, lastly on this point, especially for younger people who are below 35 years, especially young professionals or self-employed entrepreneurs between the ages of 20 and 35, embrace unit trust, embrace money market funds, but use them as a step one of cementing your savings journey, but don't forget other assets or investments. We call them growth assets. So in the class of unit trust, I would even encourage young people to also subscribe to equity funds in unit trusts, because you have three things older people don't have. So you have your time, you're young. Secondly, by the way human beings have been created, you have a higher tolerance for risk. You can make a mistake and grow out of it and have time to recover. Just like driving, when I was 20-year old and now I'm 50 years old, I drive differently. In my 20s, I was trying to be a rally driver. Today, everyone is hooting behind me to move faster. The third thing is what young people need to embrace, and they have, is the time. You know, the compounding element we spoke about? If they compound their money in 20, 15, 20, 30 years, they'll see magic. I have one of my unit trust money market accounts, which I opened in 2005. And I put very little money, and I abandoned it. I couldn't add more, because wherever I worked, I was involved in unit trust. So I had to invest in where I am, just like I am in Old Mutual. I invest in Old Mutual. I can see the power of compounding in that 2005 money market fund to today. The interest is bigger than the principal today. So the power of compounding and time is only available to young people. And I see most of your crew are young people. I hope they are listening. So they have time to do all this.
I've seen an interesting conversation about MMFs online, on TikTok to be precise. And someone was arguing that it is not an investment fund. And I like what you've said. When you get into MMFs, you should aim for the next. You talked about equities and what have you. So, is a money market fund, which is a unit trust, just for clarity, an investment fund, or what exactly is it? Or is it just a stepping stone moving to the next thing? And what is that next thing besides equities? And another interesting conversation I have seen online is around MMFs, which are unit trusts. People have been wondering, there have been rankings here and there. The best you see is one particular unit trust I see most of the time. It's new, and I haven't had you talk about the length that these unit trusts have been in operation for. I've had governance, I've had the referrals, I have had they're all regulated.
Yes.
So is it safe to invest in any as long as they are regulated, or what else can make sure that our money is safe and just not go for the one with the most referrals maybe and lose out on money? How can we be more discerning on which MMF to go with in that situation?
Okay. You've asked 3 questions, and I've got very weak memory. So I'll start with the third one, which is very, very easy. The fact that an MMF is very new, it doesn't make it a bad thing, because everyone, just like human beings, everyone has to be born on a particular day. So that MMF was born today. So we cannot say it's a bad MMF, because there's a child also who has been born today. So time is important, but should not be a key item to disregard a good product or a good MMF just because it is 3 months old, 6 months old. So my MMF at All Mutual is over 20 years old. So I should not choose 20 years old to say let's choose it for that reason only. No. So for the new MMFs, and I'll try to use what has been used a lot online to describe the best MMF, is the return. Actually, I think that is the first attraction, and I think it's right. For a first investor, the bigger the better, the higher the return, the better. So when you see 20 MMFs and 1 or 2 have the highest return, they are likely to attract your attention. But for existing investors who have been there for 5, 10 or so years, return is important, but there might be other 2 and 3 also important. So if you're starting your investing journey, I expect you to be very conscious about the return and say, I want the best. But once you identify the best high earning money market fund, now check the other things we've discussed. Exactly. Who are they regulated? What are the people behind it? What is this institution? etc. So don't just use the return and say, I'm done, I've seen this one. It's 15%. Everyone else has 10, so I'm going with 15. So use it as now a starting point to do further due diligence, and it's easy to do that. But there's one thing I'll tell you why when MMF formed in the last 24 months, I've had high returns. Why? Is because MMF returns, or rates, we call them in our professional language yields, they move with the same direction of interest rates. So if interest rates in the country are high, and by high I mean interest rates of borrowing money from the bank, interest rates of treasury bills, interest rates of government-related parameters or securities, they affect the interest offered by money market funds or MMFs. In the last 2 years, by December last year, interest rates in this country were very high. Treasury bills went as high as 16-17%. money market funds also were tracking those interest rates. So if a money market fund was set up in June last year, there's a chance it was having a return of 15%. Why? Because the assets they have invested in are high yielding. And that makes them, so the newer money market funds last year were paying more. This year, Zeddy, if you start a money market fund this year, as a new player, you'll find your return is low because interest rates have come down. So you're investing money in low yielding assets, while some of us who've been there for longer, the money is already invested in longer high yielding assets. It's a bit of an investment management class 101.
But are these longer high yielding assets?
Exactly. Those are now short-term bonds, like bonds between 1 year and 5 years, longer deposits in banks, longer treasury bills up to 1 year, etc. Because money market funds are supposed to invest in short-term interest earning or bearing assets, etc.
Wait, is it really a stepping stone? Should we use it as a stepping stone?
It is.
Other things?
Exactly. And I need to answer your question very fast. You asked, is this a stepping stone and is this an investment fund? Yes, the MMF is an investment fund. But the return is equivalent to the risk. In MMFs, the risk is quite low and easily manageable. Mm-hmm. That's why the return is not as high as in other longer term, more risky investments we can talk about. So MMFs are investment funds, but they are close to what we call a saving product, because also they have a high level of liquidity or access to your money. You know, you are earning 10-12%, but you can access your money in 1 to 2, 3 days. Now, that comes with a bit of sacrifice of the return. Now, they are an investment fund. They are more closer to saving than closer to investing, because investing brings a higher level of risk. Now, should we use them? Yes. At any one time in life, yes, because an investment product should not be the only thing you do. You need to do other things. So if you have 100 shillings, let me use a bigger number so that to excite our listeners. If you have 100 million shillings and you are a younger person, there's a chance that less than 20% of your money should be in a money market fund, because the other amount should be in longer, more growth, slightly riskier investments, which grow faster and can take disappointments and recover. If you're in my age, it should be like 50-50. Should be half of your money should be in instruments like unit trust or MMFs, and the other in slightly high growth, slightly risky assets. If you are in your retirement past 60, I won't mind you having 3/4 of your money in MMF, because you need the liquidity and you can't take risks. You have no time for mistakes. You just need to pay your bills, take care of your health, have is it bus fare or air tickets to visit grandchildren, etc. So the money market fund is a very powerful tool for both a young professional or even a student, a middle-aged professional, and a very mature, close to retire professional like myself, and also a retired professional. And again, a young business, a mature business, and a high growth business, because it helps, the money market fund helps manage your liquidity. Before you decide what to do, like today, if you just bump on 1,000,000 shillings, before you get excited about what to do, you need like maybe 2 weeks, 1 month, 3 months to think critically what you want to do. In that thinking period, where is the money seated? MMF. Because you're earning a return, it's almost like sitting there for you to do window shopping. But I'd like to conclude by saying this. There is no best investment in the world. The best investment is a diversified portfolio. There is no single asset which will meet all your investment or return needs. It's a diversified portfolio. So I know younger people today are not excited by buying land. because it has been overdone by their parents. At a time will come when that will be part of their investment portfolio. And the 5 things, as a mathematicians, I like counting. The 5 things which helps you identify an ideal investment. Number 1 is an acceptable return. You know the way you say, I like 12 and I don't like 10. So a reasonable, I like calling it a reasonable return. Number 2 should be ability to grow. If it's a unit trust, there's a compounding aspect. If it's a piece of land, should appreciate in value. If it's a share, should appreciate in value. If it's a business, should grow. Number 3 should be liquid. That means you can convert that investment to money or cash at the shortest time possible without loss of value or money, or with negligible or minimum loss of value. Sometimes you have to sell an asset for a small loss because it's not a loss. It's actually had appreciated from 100 to 200, but you have sold at 180. So that 180 is not a loss just because you've lowered your return expectation. So liquidity is important. Number 4 is security. It should be secure in all aspects. Physical security, ownership documentation. If you own an MMF, how can you prove to me this MMF is yours? There should be a document you're holding in your hand, which is an authentic representation of ownership. Just like a lease document or a title document of a piece of land.
What's the name of the document?
It's a statement.
Okay.
Yeah, the statement you have from the money market fund provider is a representation of you having an account there, and the balance there is you. So a money market balance can be used as a security to borrow from a bank. Yeah, that's how powerful it is. So that is security. Now, the last one is understandable. Don't touch any investment if you can't understand it. Even if a professional like me tell you it's complicated. It's complicated, but I have an obligation to make it understandable to you as a layman person. And if my explanation does not deliver the simplicity, you need to keep off. Because we don't want professionals to hide behind professional jargon. Because the true professional has the ability to be very technical and very simple.
If it serves them.
Exactly. So very simple that I tell you, this is a sophisticated product. Just like the way a doctor will tell you, this is a very serious illness, but in layman's terms, it means you have a very bad stomachache. So the same way investors should tell you, this is a sophisticated investment product. It has many features and parameters and moving parts. But in essence, this is how it grows. This is how it shrinks. This is how it pays you interest. This is how you can get in, get out. They should be able to explain. And in that explanation, and you don't need to be a finance professional, you don't need to study finance to understand. You just need to listen because you are literate. Okay? The best thing about education is only 2 things: ability to read and write. So if you can comprehend, read and write, understand. But if by any chance you don't understand, leave it. Now those are the 5 things I've said. No investment will tick those 5 things. So what is the best investment? The investment portfolio.
There's a discussion I have seen online, and it's very, let me just give it to you. You tell me how you believe that should go. About MMFs, is it true that it's compared to treasury bills and treasury bonds? Is it more of T-bills, bonds are like wholesalers, and then MMFs are like retailers? Someone was arguing that if you invest in MMFs, you get less returns. It has gone lower this year, as you have explained. The interest rates have gone down. But how do those two compare? Treasury bills and MMFs. Is it true that the fund managers that deal with MMFs buy and trade in treasury bills and bonds, and the returns that they get is what the USCC MMFs? What's the relationship between those 2 years?
That's very interesting. And I'm glad that that conversation is out there, and there's a bit of knowledge about it. And by the way, there's a lot of truth about what you've said. So MMFs invest in T-bills and Treasury bonds, by the way. And it's true MMFs are on the retail mass market side. And to some extent, Treasury bills and Treasury bonds are a bit on the wholesale side. But as an individual, nothing stops you going to buy Treasury bills directly to the central bank or then through your bank and buying bonds. That's what's clear. So money market funds managers, fund managers who manage money market funds, they use Treasury bills and Treasury bonds to generate the return they give you in a money market fund. But why is that a better route? Is because they give you convenience and access. There's a bit of extra paperwork in buying Treasury bills and Treasury bonds from the central bank, although I know they have really digitized that process. So they have tried to narrow that. And we respect them for that. And banks have also done the same. So the money market fund, the biggest, other than convenience and low amount, because you can't buy Treasury bills with 1,000 shillings or a Treasury bond 1,000 shillings. But you can buy a money market fund with the bonds and Treasury bills for 1,000 shillings. The third and most important thing is liquidity. Treasury bills mature either 3 months, 6 months, or 1 year. Money market funds, you can get your money between 1 and 3 days, depending on which fund or fund manager you are dealing with. Now, that liquidity advantage makes highly advisable for you to go to money market funds. The last one is this. When you're buying a money market fund, you can see the return. Which is, when you see the return every day, just know that that is yesterday's return reported today. And it's important for members of the public to know that. Because the return for today will be reported tomorrow, because it is published end of the day after the fund is valued and numbers are done. In T-bills and bonds, there's a bit of knowledge required in bidding for those, because it's an auction. We all buy at different prices. So if you see a T-bill is 12%, there are people who have bought at 11.9, 12.1, 12. So the same with bonds. So there's a bit of skill and knowledge required. That's why fund managers, banks, insurance companies, institutions, and a bit of sophisticated, high knowledgeable investors tend to go directly to Treasury bills, Treasury bond, because they have slightly knowledge on how to bid for those securities, for they are sold through an auction. And secondly, they don't mind any associated cumbersomeness in buying them, even though that cumbersomeness has really been reduced by the promoters of T-bills and bonds with the Central Bank of Kenya. And fund managers are one of the biggest customers of the central bank, and we have a very close relationship, and we are grateful for their continuous provision of those securities to be used as investable assets for money market funds and unit trusts in the country. Yeah.
Thank you for that. There's this concept about money that you get wealthy by not using money. You first acquire it, but the wealth is created by you not using it, by you having it. And there's also a notion that wealthy people are taxed less. Please speak to those two.
I mean, the first question actually just talks about, to build wealth is a huge calling for self-denial or suspension of current consumption. And that, if you look at anyone who has built wealth, there's a lot of measure in how they have consumed their income. It is by default. As an employed professional or person, you are highly encouraged, if you can, save anything between 10 and 30% of your income. So every time you get 10,000 shillings, 3,000 needs to be put away. Now that is the hardest part. And it has been proven it has a relationship to building wealth, because you are saving more and consuming less. Because remember, another 30% goes to tax and that. and then the remaining pays your bills because you need to stay alive to continue earning that 10,000. Now, the concept is not complicated. It just says people who, and we've seen in life, a bit of conspicuous consumption of luxurious, non-investable services and products leads to a bit of potential old age poverty. Or, yeah. So there's a direct relationship between you earning £1,000,000 and spending £1,000,000. That relationship is clear. And there are so many examples of people who we know have built to high earning from business or individual, but they struggle to build wealth. So the second part of you is about taxes. The wealthy don't pay less taxes. They actually pay more taxes. The difference is this: they have more flexibility in structuring their income. Because remember, various income levels are taxed differently. Income tax is taxed differently at different rates. Withholding tax is a different, and there are other many sources of tax. I'm not a tax expert, but what makes us feel that wealthy people pay less tax is because they have a more flexibility of tax avoidance legally than lower earning people or less wealthy people. In law, tax avoidance is legal, but tax evasion is illegal. Tax avoidance is making sure you spend and invest your money in areas where they are low taxation level. But if you are buying bonds, treasury bonds, and you buy only infrastructure bonds, you never pay tax. So it's called tax avoidance. And it has a relationship to not necessarily a lot of money, but a relationship to seeking advice, knowledge, exposure. Dividend income is taxed differently sometimes, and other sources of income. So wealthy people tend to have that flexibility, and that flexibility comes with them paying what they call lower effective tax. But it's because of a lot of flexibilities within the law, not refusing to pay. Yeah. Yeah.
I would want to know from your knowledge and from your life, what is the best financial advice that you have ever received and it has stayed with you over the years? And from whom was it from?
One of the people who really made a difference in how I view money is my third employer. He was the managing director or CEO of a fund management business I worked in. In fact, in Kenya, there's a very famous fund management award which is named after that person because he passed away just out of honor of him. And I was very fortunate to work with him for 3 years, almost over 15, 18 years ago. And there's one thing he told me is that anytime you're investing, separate this as an investment of the heart and an investment of the mind. He told me investment of the heart, it means you can keep it even if it's not making you money. You just like associating with it. You're satisfied with it. Just like the way you build a rural home or you own a home which is expensive to maintain, but you like living there. So that's an investment of the heart. Then separate an investment of the mind. Investment of the mind is where you have applied the things you're discussing here. It has to make sense. If it does not make sense, it's available for sale at the right price. And I've actually structured the little things I have in those two buckets. The things which are available for sale at the right price, and the things which can never be sold. They're investments, but they can never be sold because of certain personal comforts and happiness they provide to me and my people. Yeah.
So investments of the heart and investments of the mind. That's very powerful. I'll try to remember that. Anthony, I know, and most financial experts speak to this. You cannot grow if you run away from debt. How can we purpose to move away from bad debt and actually create wealth at the same time as you are managing the debt situations in our lives.
And that's a good topic. I know we can't complete, but debt is a huge part of a financial wealth creation journey. It is. If you avoid debt all your life, you have missed something. You realize you've moved slower. But if you misuse debt, you move slower completely, and even you may not even rise from the surface. So, one of the benefits of debt is it allows you to leverage or to take advantage of your initial investments. And you've given, for example, assuming you have a money market fund account which is worth £1,000,000 and every month you put 10,000 and you keep on that journey. And you don't want to touch it. But you need money to buy a car. You need money to go back to school. You need money to, I don't know for what. For many reasons, you need money to pay a medical bill. Although I'll encourage you to get a medical cover than borrowing to pay a medical bill. So you need money. The benefit of investments and debt is that you can borrow and your initial investment, they lower the cost of your borrowing by offering that as a security, because there's a difference between cost of borrowing for secured lending and unsecured lending. Because when you give a collateral or security, there's a chance the bank will charge you a lower interest in appreciation that you have lowered the risk that you not run away with your money you do not have to pay. Now, in business, debt is more powerful because debt helps you accelerate your business, grow your business, expand your business so that more revenues can grow your business while also paying the debt. But it is the easiest way also to fall in the trap of over borrowing to over expand your business. And that's where the problem is. Debt is a double-edged sword. It can grow your wealth and it can also stagnate or almost impair or eradicate your wealth, unfortunately. It just needs to be. If there's one of the biggest advices we should all get is our relationship with debt. It's good. It's good to have a credit card. It's good to borrow from a Sacco, from a bank. It's good to borrow from investors. It's good to leverage, but there are parameters which should be a measure when this is becoming negative and not positive to you as a person or to a business.
I believe it's fueled by the fact that debt is very easily accessible nowadays compared to a few years ago. And I'd like to have you back so that we speak about those parameters that you have mentioned. As this is a Power Dialogue Africa, we believe in empowering our listeners one conversation at a time. I'd like for you to share with us at least three practical lessons that anyone can take to set themselves to a path of financial freedom. What are these any three practical steps that you believe are easy and anyone can just embrace to help their financial situation?
A lesson, even for myself, is from the day you become gainfully engaged from a business earning or from an employment, especially for a young person who has just left school, is you should just decide saving money is part of earning money from the onset. Saving is part of your earning journey. So the day you get income, which is out of your own sweat, skill, energy, or effort, I know young people are coming from an allowance culture. When that comes to an end and they earn their own earned money, they should start saving. And those ones already earning an allowance, please save part of it because it leads you all your life. It will teach you how to deny yourself. And that's a very powerful lesson. I came to learn very late about that. The second one is caution on what generates money. If you're a young entrepreneur, a young person, you just left school, Do you know what's the most important thing for you to make money? Is actually yourself. You're the biggest asset for yourself. Your life is the biggest asset. If you're not there, there's nothing. So you need to, from day one, protect yourself, your life with extreme caution and no apologies. So any decisions which have a potential to impair your physical fitness, health, ability, mental or otherwise, you immediately pay a lot of attention. When you are older, some of us have come to know the importance of good health when late in life. Because when you are young, a hospital or a doctor is the least person who you have a conversation with. But when you become older like me, that becomes becoming frequent. So the second lesson is that please take care of yourself, because that is the vehicle to build wealth. Your hands, your brain, your skill, your talent, that is you. As you move on in time, you will discover you are less inclined to be there. Money is being made on your behalf, even in your absence. So you realize your physical presence, ability is not required, because you're a business owner or you're a boss or you're things like that. So things can move without you, but the fact you need to be there. And that's a very important lesson I came to learn very late. And I think I have young adults in my house, and I tell them, you don't have anything here apart from your health, your body. So everything here is for your mom and dad. The rest is not. So the third one that I think it's becoming increasingly important as a lesson for people who are seeking financial freedom is actually financial literacy. Get informed. Don't get informed because you have money. No, just get informed. You know the way we know everything is happening, for example, in the political side, and you're not politicians. Why don't you get informed on things which are more important to you? So financial literacy is so important. Don't say, I studied accounting, I studied finance, studied economics. I know, no. I'll tell you, this simple conversation we've had here today, I have them with CFOs, with finance managers, with accountants. So whether you are an entrepreneur, you are in science, you are in arts, you are in finance, you are in technology, you are in public life, you are a public servant, you work in a company, you are a business person, you are a farmer, or anything, just get financial literacy. You know, back in the village, I was very excited when one of the people who were helping me do something, I'm a struggling sheep farmer. So when someone was helping me do certain things with the flock, he told me, wow, you know, this is equivalent to, and I was very impressed. This is equivalent to those investments people call MMFs. And this is deep in the village. I just said, the gospel has moved from the city to the small areas. So financial literacy is a paramount for all of us. Make saving part of your earning. Yes. Because like paying yourself. Secondly, take care of the most important thing you have, which is your life. And thirdly, get into financial literacy and continuously. You know, you won't be an expert. The things I'm talking about today, I didn't know them 10 years ago, some of them. And when I retire, and assuming I have some money to invest, I need to be financially literate by talking to people like all of you here. So after MMF, and I left the city. Yes. So what's the new what's the new buzzword? So financial literacy is a lifelong journey, and because it's not harder, we can understand it. Social media. If you can listen through a TikTok or online through Facebook, Instagram, LinkedIn, if you can listen to a podcast and understand, all the avenues are there for financial literacy. You don't have to sit down and listen to a channel or watch news like me. I believe I'm the last people who are watching news. Just look for avenues to financially make. If you're in a discussion, you're having your Friday drink, weekend party, let financial discussions or literacy eat some time from politics. Let politics share time with discussions about financial literacy. If you find yourself you're the most knowledgeable, talk to it so that people can challenge you those beliefs. If you're very excited about MMFs, talk about it so that the people who don't believe in it can challenge you and make you raise your justifications higher. Yeah, thank you.
Please share with us one very unique, peculiar, and misguided notion you've had about finances that really eats most of us Kenyans. And my next one will be, how do we inculcate a better financial literacy to the younger generations and those coming after us? How do we do that?
First one is a bit tougher, but I'll use a simple example. And it used to be part of my rules of thumb, but I've discarded it. I used to believe a car is not an investment. Because for two reasons. It consumes money from you, fuel, insurance, and the garage, but does not give you an income, and it's very in value. Today, a car is a tool for production. So the fact that the car takes you to work is helping you be effective.
It's true.
The fact that the car is earning you money as an Uber driver is it. The fact that the car is a pickup, carried goods, and delivers produce to the market. So that notion that a car is not an asset, especially for investment professionals, let's accept that's wrong. Yeah, I think two things for me. First of all, start very early. When my kids were younger, I used to go to their school to speak about money and young people, or money and the youth. And I once spoke to a class of, and you don't believe it, that is more than 15 years ago. They were able to differentiate between saving and investing. A young girl told everyone seated in a small classroom, saving, it can't get lost. Investing sounds like it can make more money, but it can be lost. That was extremely powerful. So start early in young people. And then number three, put it in their language. Gamify it. Use their language. If the English you and you are speaking is not the way of communication, put it in their language. Put it in mother tongue. Put it in Sheng. Gamify it. Use symbols. I mean, if all of a sudden you were not trained and all of a sudden all these emojis came up and we were able to know what they mean, and no one went to school to study emojis. So if those are that's the language they use, accept use those symbols to pass them out. Speak their language. Yeah. Don't offer financial literacy through a very formalized do and don't, but offer it through these are the possibilities.
That's very powerful, and thank you for that. I'd wish to know what inspires you to keep churning out and empowering this generation with financial literacy, and what keeps you going on your tough days when it's a bit tough?
I think for the first question is, investment management or asset management in Kenya is less than 30 years old. It's a mid-90s thing, 1995. And I've been there in 25 years because I left school around 99, 2000. So what keeps me going is because almost everywhere I've worked, I've always been the older person, which is which is not unfair, but it's very unique because asset management in Kenya has people to a large extent younger than me, between the ages of 20 and 40, and I'm 50. So the fact that I've been stuck with young people for the last 25 years has helped me give a lot of unsolicited advice, which is very dangerous, and a lot of pushback, because they have more information and knowledge than me. All the things I believe in all the rules of thumb have always been turned upside down, of course with facts, and I love the challenge, but it's just because I can see the difference. I've seen people who left school when I'm working, and today they can offer me a job. They've built institutions where I've gone for interviews where a former intern is sitting on the interviewing panel, interviewing me. And that shows you that wow, I will keep doing this because it's having a difference. I identified a lady many years ago, over 15, 18 years ago, to work for me where I was working. And she was coming from a non-financial background, and we gave her a chance for only one thing. Those days, CVs were sent physically. So we had a pile of CVs in the office like this, and I was to choose 10 people to be interviewed. I chose the CV because it was printed in yellow. It was very conspicuous in the crowd. And I looked at this, looks interesting, not from financial services, from public sector, but very good language skill, looks very passionate. I said,
Outstanding.
yeah, just include this in the pack. She got hired. I've worked with her more than twice. Today she's a CEO of a fund manager. So passage of time when you've come a bit earlier keeps me going. And how do I handle my tough days? I keep on changing. I used to handle my tough days when I had better ears through loud music when I'm driving to work or driving to a tough meeting. Today, I think, and I hope my wife is not listening to this, I actually look forward to because I've the menu in my house memorized Monday to Friday. So I motivate myself that I need to earn that dinner tonight. So I need to remain sensible, focused, optimistic, because unlike many other people, there's going to be a plate of food in the table in the evening. And that makes me get away of all shouts, discouragements, clients, outbursts, sometimes good information, sometimes big wins. It makes me not overexcited about big wins, but I actually do. And it makes me know that there's another day to wait for another dinner session.
That's very powerful. And because you're very motivated, I'd want to know what is one failure in your life that taught you more than what success will ever teach you?
There's one I normally use a lot. It has a relationship to investing. So close to 20 years ago, I was given a very big assignment to advise a very prominent executive who was about to retire. And he had a lot of money. And I was to create an investment structure for him. And because he was so happy what we did after 1 week, he took me to a drive to show me where he's going to retire, where he's going to build his new house, and the reason why he chose that place. And he took me to that place, to a big place. And my generation is my generation of land. He told me, all this is mine, but this can be yours if you also please buy it. I just told him, no, first of two things. I don't like it. I was very blunt, very entitled 30-year-old. I told him I don't want it. He told me why. He was a bit shocked. Why? Because the answer was so strong. I told him I don't like it. I don't have the money. He told me, forget about the first reason about the money. I want you first of all to like it. And I insisted I don't like it. In fact, I can see there are some zebras here. If there are zebras, there must be lions. So I was very opinionated about why not. And I lost a huge chance because if I made that investment, because I could have gotten the money. I was working in a bank. I would have gotten the money. Today, I'd be retired if I did that. If I did what he did. And he was 65 years old. I was half his age. I was 30.
Why did you like it?
I've never known why. And out of that, I almost went in a land buying spree.
You like everything after that.
Because 10 years later, I saw the mistake I did. And it was a very hard lesson for me that, you know what, anytime something you don't like, you don't appreciate quickly is offered to you, not for free, but as an opportunity, before you say no, give it a thought. Give it a thought and say, you know what, do like what your parents will do, I'll sleep over it. It's weird for a 30-year-old to say I sleep over it because you're supposed to give an instant answer. But I've learned that that was a very hard lesson for me because I paid huge premiums to come close to what I disregarded then. Yeah.
We take our lessons from there. At the Power Dialogue Africa, we believe in celebrating legacies that inspire progress, and there's no better partner for this vision than Sarova Panafric. Born from the bold ambitions of Stelios Stylianides and inaugurated by Kenya's founding father, Mzee Jomo Kenyatta, Sarova Panafric is more than a hotel. It's a symbol of Pan-African unity, cultural celebration, and visionary leadership. Just as the Power Dialogue Africa brings together trailblazers from across the continent to share ideas and ignite change, Sarova Panafric has for over 6 decades hosted presidents, pioneers, and patriots who shaped Africa's future. Today, it stands as a beacon of neo-African elegance, blending rich tradition with modern comfort, all while championing sustainability and community empowerment. We are proud to partner with Sarava Panafric, a space where history meets innovation and where Africa's stories continue to be written. Here's to creating powerful dialogues in a venue that embodies the very spirit of our continent's rise. What do you believe is the most African thing about it?
Wow. I was unfortunate I was not born in my village. I had to come back to that village. I was raised in Coast. I went to school in Mombasa and all that. But what African means about, I have this feeling that the city is not home. That I have to go back to the village after I'm less useful in the city. And a lot of people have contested. They've told me, no, this is Nairobi is for everyone. My kids are born in Nairobi, but I believe I'm a very, very deep village at heart. I can't wait to retreat back to back out of town, and that I think is very African because Africans believe that that they came from somewhere, and when they're done with professional life, they need to go there after they wait for the other final place. And I think that that's not very European. I'm fortunate to have a daughter who is schooling abroad, and I don't think she has that mindset. I don't think she considers any location. Exactly. It's where he or she is at the moment. As much as we all tell everyone home is always best, and home has a relationship with where either your people came from, your clan came from, your parents are, or your grandparents are. So I still hold that, and I struggle to even in my office. They ask me, why do you drive all these kilometers almost 2 or 3 times a month? I said, I went home.
And they don't relate.
No, they don't.
I really relate, just to give you assurance.
Okay. Okay.
I want to know, talking about home and all, what's your best destination in Kenya and why?
As a tourist, it has to be very close near the fence of Mount Kenya.
Why?
Because I have less affinity to the beach as a tourist destination because I spent a lot of time in Mombasa. Yeah, not to live there, but just to drive there. Yeah, and just have a look. Yeah.
We'll try and get those passwords we appreciate what you appreciate.
Yeah.
Your parting shots in Somalia and where we can seek your services now that we know when we get the products.
Yes.
The consultation is an added advantage.
Yeah, so thank you for having me for this conversation. So, in conclusion, I like to say this: the journey of wealth creation and financial freedom is a worthwhile try for everyone. It's possible and should not be defined by our original knowledge or our original income potential. We should not embrace financial knowledge, or we should not believe in financial freedom or wealth creation just because we either started on a good footing or we desire to have a good end, but just because it's a part of life's journey. And we do that at Old Mutual. We advise clients from their infancy to their retirement or legacy ambitions. Old Mutual in Kenya is based in many parts of the country, in most of the bigger towns. But in Nairobi, which is our head office headquarters, we're in Upper Hill at Old Mutual Tower. People know the Old Mutual Tower for New Year's Eve celebrations. We
one of the most
we try, and we are grateful for that. It tries to represent us on New Year's Eve like any other cities in the world. As I said earlier, we offer unit trusts, both in shillings and in foreign currency like dollars. We offer other forms of unit trusts like equity fund, balanced fund, bond funds. We manage pension funds. We manage liquid cash for corporates and individuals. And we also provide both local and offshore investments. It's not only local alone. And our products are not driven by the amount of money you have, but they're driven by your financial goal. It's not the amount of money you have, it's the financial goal you have. And it will become part of the All Mutual journey with us. Thank you.
Thank you so much for your insights, and we will look that up. And I can't wait to have you again to speak more about that and other parameters that are a bit tricky for us non-financial people. Thank you so much for coming today.
Thank you.
Until next time, I have been your host, Zeddy Bariti, for the Power Dialogue Africa. I will be cheering you on and encouraging you to your next power move. Thank you. Bye, and see you on the next one.